Happy Tuesday, everybody. Welcome to another episode of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Tuesday morning, today, local time, China dropped a whole bunch of official data on the economy for Q2, and as such for the first half of the year. As always, we take official numbers with a grain of salt. We also notice the same thing we always see. While the headline number looks okay, as we dig into the details, a much more concerning picture takes shape. China's economy expanded 5.2% in the second quarter of 2025 year-on-year, surpassing analysts' expectations, but highlighting an ongoing imbalance between robust industrial output and persistently weak consumer demand. Regular viewers will know that this is exactly the opposite of what policymakers are trying to achieve. Indeed, much of this momentum was driven by resilient exports to markets outside the United States, which we will cover soon when we look at the trade data, and strong manufacturing output rather than a revival in household consumption. We remember that in China, unlike the rest of the world, GDP should be viewed not as an output of economic activity, but rather as an input. Beijing sets the target and local governments meet it, so the question should never be how fast did China grow, but rather what was the composition of this growth, or more specifically, how much of it was healthy growth. Beijing has been trying to shift its balance from manufacturing to consumption. The data will show that this still has not happened. It will also show that the housing crisis, even after several years, is getting worse. Industrial production rose 6.8% year-on-year in June, with manufacturing output climbing 7.4%, the fastest pace in 3 months, even as Beijing, for the last month, expresses growing concern for overcapacity. In contrast, retail sales grew just 4.8%, falling short of the projected 5.5%, and marking a notable deceleration from May's strongest showing. Quote, "The data underscores a structural challenge. Supply is healthy, but domestic demand is not," end quote, said Societe Generale's Greater China economist Michelle Lam, adding, quote, "Export strength won't hold forever, and without a consumption rebound, growth momentum will fade," end quote. However, calling the supply side healthy might be a little overgenerous, as even official numbers show that this manufacturing output is being sustained by surging debt. The retail slump was most evident in falling sales of consumer staples like beverages, alcohol, and cosmetics. Growth in catering services also slowed, while gains in home appliance and electronics sales were largely driven by government subsidies. Further compounding concerns, the GDP deflator declined for the 9th consecutive quarter, the longest deflationary stretch since quarterly records began in 1993, thus the worst ever on record. Weak prices reflect subdued consumer confidence driven by prolonged property downturn and wage stagnation. And of course, this is no surprise. Household wealth is 70% held in real estate, and if the real estate market continues to decline month on month for several years, it is no surprise that households are going to change their spending habits. Investment data also paints a mixed picture. Fixed asset investment rose 2.8% in the first half, but real estate investment plummeted 11.2%, the sharpest drop since the pandemic began. New home prices fell 0.27% in June, and used home values declined by 0.61%, the largest monthly drop in nearly a year. Residential sales slumped 12.6% year-on-year in June. The property malaise is spreading even to China's largest cities, where used home values in all 4 Tier 1 hubs fell more than 0.5% in June. This is a deeply concerning sign, as for the longest time, most of the pain was being felt in the lower tier cities, with the Tier 1 cities showing the most resilience. Investor hopes for fresh stimulus lifted developer stocks last week, which we covered at the time, though gains reversed today amid renewed uncertainty. Shares of China Vanke slid after warning of a potential $1.7 billion first half loss. Looking ahead, policymakers face a delicate balancing act. With US tariffs potentially returning in August, China must preserve policy space while addressing flagging domestic demand. Economists expect that any steep slowdown in the second half will trigger a fresh round of stimulus. Wei Chang-ho of United Overseas Bank observed today, quote, "The economy has resilience, but sustained current momentum without stronger household consumption will be difficult. Stronger policy support will likely be needed later this year," end quote. Next up, now let's move to trade. China closed the first half of 2025 with a record trade surplus of approximately $586 billion as exports showed unexpected strength despite escalating global trade tensions and tariff disruptions. According to data from the General Administration of Customs published yesterday, Monday, exports in June rose 5.8% year-on-year to $325 billion, while imports edged up just 1.1%, marking the first increase since February. Once again, this shows the structural imbalances, however. Manufacturing subsidized by the state is being exported, with weak imports showing weakness in demand. A major factor behind the robust performance was the stabilization of exports to the United States. Although shipments to the US were still down 16.1% compared to a year earlier, that represented a significant rebound from the 34% plunge recorded in May. Analysts attribute the recovery partly to temporary tariff relief following US-China trade talks in Geneva in May. Chinese exporters also found new momentum by expanding into alternative markets. Exports to ASEAN, the Association of Southeast Asian Nation countries, surged 17% year-on-year, helping offset reduced demand from the US. However, several analysts suspect that these are simply goods transshipped from Southeast Asia to US markets to bypass restrictions. This diversification has provided a buffer for China's slowing domestic economy. However, the trade outlook remains clouded. The US is preparing to implement new tariffs on the 1st of August, including a 50% levy on copper and heightened scrutiny of transshipped goods. A recent US-Vietnam agreement introduced a 40% tariff on goods deemed to be Chinese exports rerouted through Vietnam, undermining a long-time strategy used by Chinese firms to bypass American duties. Rare earth exports have also drawn attention, rising 60% in June to 7,742 tons, marking the highest level since 2009. This comes amid China's ongoing export controls, which have roiled global supply chains for magnets used in electric vehicles and defense systems. China controls roughly 90% of global production capacity for rare earth permanent magnets, putting global manufacturers on edge. Council on Foreign Relations Senior Fellow Brad Setzer observed on all these numbers yesterday, quote, "Just a reminder that China's trade surplus continues to set new records. The second China shock is still underway. The surging surplus stems from the success of many Chinese sectoral policies: batteries, EVs, industrial robots. It also reflects China's deeply unbalanced domestic economy, which still struggles to generate demand sufficient to absorb China's production." End quote. If you want to continue to be on top of the most up-to-date developments on all things related to China and the broader emerging Cold War which our world has now entered, consider subscribing to China Update, hit the bell notification icon, and you will be. If you're getting some value from today's episode, it's a tremendous help for the channel if you hit the like button too. And for those who want to help keep the channel financially sustainable, I rely primarily on subscriber support to keep going. All episodes are open and free for all, and I want to keep it this way without having a corporate reliance. Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. Next up, and finally for today, I am accused sometimes of never covering positive news. This is not the case. I cover whatever the news is. It's just in the last few years China has faced serious structural issues, and so these have been the stories to follow. But there are some bright spots, and today we need to cover one of them. The global biotechnology industry is undergoing a seismic transformation as Chinese drug makers emerge as serious challenges to Western dominance in pharmaceutical innovation. Once known for copying Western drugs, China is now redefining its role in the sector, not as an imitator, but as a pioneer of novel treatments. From cancer therapies to obesity drugs, Chinese firms are not only innovating at scale, but increasingly winning international recognition, investments, and regulatory endorsements. According to recent analysis of Nostella data, Chinese developers launched over 1,250 innovative drugs into development in 2024, outpacing the European Union and narrowing the gap with the United States, which led with around 1,440. Just a decade ago, China accounted for less than 6% of the global drug pipeline. Now it is a serious contender, driven by regulatory reforms, government policy, and a generation of globally trained scientists. Quote, "This scale is unprecedented," end quote, said Helen Chen, managing director at LEK Consulting in Shanghai, adding, quote, "The products are here, they're attractive, and they're fast," end quote. The transformation began in earnest in 2015 when Beijing overhauled its drug regulatory system to streamline approvals, enforce higher data standards, and boost transparency. Backed by the government's Made in China 2025 plan, investments poured into biotech, led by scientists returning from the United States and Europe. These changes helped spark a biotech boom that is now bearing fruit. China's biotech breakthroughs are increasingly luring global pharmaceutical giants as well. Pfizer recently inked a record $1.2 billion upfront deal with 3S Bio for a cancer drug. These deals reflect not only the scientific potential of China-origin drugs, but also the efficiency of Chinese clinical trials. With access to a large patient base and a streamlined hospital system, Chinese firms can recruit trial participants and complete studies much faster, often at half the time and cost of US-based trials. Since 2021, China has led the world in initiating clinical trials, according to the firm Global Data. Despite rapid progress, challenges remain. US regulators still require data from international trials before granting approvals. Chinese companies aiming for Western markets must prove efficacy across diverse populations, a complex and costly hurdle. Moreover, many Chinese firms still focus on super Me-Too drugs, improved versions of existing therapies, rather than first-in-class breakthroughs. The most cutting-edge innovation remains largely concentrated in the United States, Europe, and Japan. Nonetheless, China's progress is undeniable. Of the 50 companies with the most new drug candidates from 2020 to 2024, 20 were Chinese, up from just 5 in the previous 5-year period. Longtime generics manufacturers like Jiangsu Hengrui Pharmaceuticals have reinvented themselves as innovation powerhouses, topping the global list for new drug candidates. The market is following all this too. After a downturn in 2021 caused by market turmoil, political tensions, and domestic regulatory crackdowns, Chinese biotech stocks are surging again. The Hang Seng Biotech Index is up over 60% in 2025, fueled by investor optimism in oncology breakthroughs. Still, the specter of US-China rivalry looms. The Trump administration is weighing tariffs of up to 200% on pharmaceuticals. A congressional commission has warned that reliance on Chinese biotech poses national security risks, sparking calls for export controls and domestic regulatory reform to help US firms compete. Nevertheless, as China's biotech sector matures, its role as a global innovation engine will no longer be a surprise. It has now become a new normal. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Tuesday, and I will see you for another episode either tomorrow or on Thursday.